more comments in a written form, you can always ask them to kindly do so, and I'm pretty sure they are willing to yield that kind of service to you as you appreciate. Any questions? Do you have any questions?
Sì, è che se non fate il microfono, se chiediamo sti due, forse li mettiamo di voi, all'occorrenza magari li utilizzano.
Bobba. Great. Thank you very much. It's a great pleasure to be here in Rome, a place where so many famous people gave speeches, not on share buybacks, but on other things. How many of you still need to find a dissertation topic? Nobody? Because normally I give advice to students how to find a dissertation topic. I was a student at the University of Chicago in 1977, and I was in a study group with two other people preparing for the comprehensive exam. And one of the persons in the group, let's call him John, where he flunked the exam once. And in Chicago, you can get two chances, right? If you flunk the exam once, you can try again. If you flunk again, then you're kicked out of the program. So at one time during our meetings, we were discussing what should we write our dissertation about. And I had no idea, and the other guy had no idea. But then John said, well, once I finish the exam, I will write a dissertation on share buybacks. So what happened to John? He flunked again the exam. So I took his topic. The other guy in the group did a dissertation on bond buybacks. So my advice to you is surround yourself with creative people that are not very good at taking exams. I'm going to talk about share buybacks, the past and the future. Now I'm going to talk only an hour and 15 minutes, and it doesn't cover all the topics, but I strongly recommend for those of you that are interested in the topic in depth is to read the chapter in the Handbook of Corporate Finance written by Alice Bonamé and Kathleen Kahle, Share Repurchases. Those of you that want to do empirical research on this topic, most of the data of announcements on buyback come from the Security Data Corporation merger and acquisition file. Now this file is an old file, goes back to 1980, data until 1980, but it only separates open market buybacks from the other methods. It doesn't go in detail into the other buyback methods. If you want to get more detail on the repurchase methods, you have to go to the SDC repurchase file. The problem is that this file only starts in 94, so there's a trade-off here. So why is buybacks, I thought, was interesting because it's a nexus of corporate finance. You can say it's a payout decision. You can say, well, should we pay dividends or buy back stock? It's a financing decision. You increasing your leverage. And it's also an investment decision. You're investing in yourself. You're buying your shares as an alternative to investing in a project or maybe buying a company. So those of you that are in asset pricing actually could find some interest in this topic because there is a major anomaly here in buybacks that the market seems to be underreacting to buyback announcements, which has implications for asset pricing and the anomaly literature here. If you look at the number of announcements here that you see from 1980, you can see there's a big increase. Some years we have more than 2,632 announcements. These are announcements of buyback authorizations. It's important that this is not actual completed repurchases. In the world, you have to get permission to buy back stock, and you can either, this permission can be given by the board of directors, such as the US, or you have to ask the shareholders in a meeting to get permission. So that's mostly the case in Europe, right? But these are just kind of authorizations. They're not actually completed repurchases. If you think about volume, if you look at what is the dollar volume of the buybacks in this case, in one year we have close to $1.2 trillion of buyback announcements that were made in 2018. When I started my dissertation, there were basically only like 25 buybacks per year. And it was mostly US data. Today it's not unusual to find 25 buybacks every 2 weeks. And also, it was a completely US phenomenon. Basically, the activity used to be illegal, and the typical arguments of the lawyers was that it's a manipulation scheme. You can manipulate your stock by buying back shares, maybe say at the last half hour of the day to get the better conditions in an acquisition where you pay with your own shares. It's a form of insider trading because if the management owns shares in the company, a repurchase really is equivalent to insider buying. It's a form of tax evasion. In many countries, such as Belgium, there's no tax on capital gains. So they said if you allow buybacks, companies will stop paying dividends, and the government will lose a lot of tax revenue. And then also in many European countries, as you know, the idea that the company should maximize shareholder value is not always shared by the corporate governance codes. In many cases, it's about maximizing stakeholder value. And most people think that other stakeholders can suffer through buybacks, especially the creditors, because you're making the leverage of the company go up, and you're making it more risky for creditors. And also workers may not like buyback for the same reason. You can see they're like also fixed claim holders in the firm, and they also have preferred that the company uses the money to increase salaries than to give money back to stockholders here. And that has kind of was the drawback. Now, what has happened is that now buybacks are legal in many countries around the world now because the regulators have been trying to dealing with this concern. First of all, the manipulation concern is that now typically you can only buy back a certain percentage of the average daily trading volume in a look-back period per day. Typically that's 25%. In order to get the concern about insider trading, there are now blackout periods. You cannot really buy back stock prior to earnings announcements. The tax evasion issue was solved by changing in the tax laws. In some countries, actually now, even repurchases get taxed one way or another. And also, as I'll show you later on, it's not the case that companies have cut dividends because they're allowed to buy back stock. In most cases, they've added buybacks to the dividend payments, but they have not really eliminated dividends whatsoever. And then hurting creditors now, bond covenants introduce basically restrictions on buybacks the way they have restrictions on dividends. And the workers' resistance has basically been solved, especially by giving workers equity stakes, stock options like that. That makes the conflict between shareholders and workers kind of go away here. Now, by the way, this is essentially why I think we're going to talk about the future of buyback research. As you can see here, this shows you the announcements. In red are 5 companies listed in U.S. markets, and in blue in the rest of the world. And as you can see, until, let's say, 1998, the whole buyback scene was dominated by U.S. announcements. And then afterwards, we've seen now that buybacks are more frequent outside the world and the rest of the world than in the United States. And this, I think, creates a potential, I think, for research, because there have been papers published on buybacks in, I don't know, Indonesia or whatever, maybe even Belgium. But these papers do not get published in top journals because the number of provisions is too small, the time period is very limited. Today, I think you can actually write papers on buybacks in other countries than the U.S. because now you have bigger samples and longer time horizons here. For example, here, this is the number of buyback announcements in the U.S. over this period is 27,000. But you know, Japan actually has a lot of buyback announcements. It's 5,480. Canada, Australia, Hong Kong, Taiwan, China, France, UK, and South Korea. You know, if you have a sample of 584 observations, then that's kind of a respectful sample that you can actually do some research, especially if you do research that addresses some of the controversial issues that are being discovered in U.S. research here. There are different methods to buy back stock, the open market buyback programs. You can do private repurchases, fixed price tender offers, Dutch auctions, and accelerated buybacks. In the open market buyback program, it's really a very loose commitment. The board will announce we give an option to the CFO to buy back stock from time to time, depending on market conditions, during a specific period of time, usually 2 years, and this is an option. You do not have to exercise this option. This is explicitly made clear in the press release, saying that we may not buy back any shares whatsoever. As I said before, there will be restrictions on trading volume to deal with manipulation concerns. For example, in the US, you cannot buy back stock the last half hour of the day or the first half hour, because these prices may determine, for example, the terms of trade in an acquisition. The buyback blackout periods to deal with insider trading concerns also are relevant for open market buyback programs. Now, private reports, to give an example here of Barry Corporation, is an oil and gas company. Say that last week we were approached by one of our largest shareholders with an opportunity to repurchase a significant number of shares, which our board approved and we acted on. Based on the current stock price, the purchase price for these shares was an attractive return for the Barry shareholders. So these buybacks are initiated by the seller. So you have a large investor that wants to sell his stocks because it has liquidity issues. But if you're a large investor and you sell shares in the open market, especially from a small company like Barry, people will think, well, he must know something. The company's in bad shape. You will get a very negative price reaction if you do that. So therefore, what the seller will go to the company and say, listen, if you buy back my stock, then you will avoid that negative price reaction. In addition, I'm going to give you a benefit. You can actually buy my shares at a significant discount from the market price. So this is why it's a win-win situation for the seller and as the company. So this is a quite common method, especially in outside the United States in terms of buyback methods here. Dutch auctions, there are two types of tender offers, fixed price and Dutch auctions. And in the Dutch auction, essentially what you do, you go out and ask investors to, each investor says, I'm willing to sell shares at that price, and the company has specified limits. We want to buy back 1 million shares between $20 and $15. And $15 is typically the current market price. And then every shareholder has to fill out a form and send it to the investment bank to say at what price is she willing to sell her shares. And then you see essentially here that you get the supply function here. And you can see there's a whole bunch of people that say, I only want to sell shares at $20. But there's some people that are willing to share at 15, very low prices, typically small investors, because they know that the way the system works, that afterwards the investment bank will set a price where demand is equal to supply. In this case, that's $17. So everybody will receive $17, even if you filled out $15 on your form, which means if I'm a small investor and my goal is to get out, then I just fill out 15 because it doesn't matter. I have no impact on the price. And that's what it basically means, that this curve may actually be very flat because small investors will put in low prices. In this case, the firm buys back 1 million at $17. This is in some cases a better method than the fixed price. And the fixed price, what you would do, you would say, I want to buy back 1 million shares at $20. If that happens, basically, you would have to pay $20 million for 1 million shares. So a Dutch auction, you can say you save here this money, this $3 million is being saved in this transaction. You're buying back stock cheaper. At the same time, when I want to buy back shares, I want to buy back shares from, I would say, the pessimists, the people that are likely to sell their shares to a hostile bidder if someone comes along. So in a fixed price, you have to treat everybody the same. If there's in this case, it will be oversubscription. More people will tender the shares than the company wants to buy back. In that case, the company has to buy the same percentage of each shareholder, including the pessimist and the optimist. Here, what you do in a Dutch auction, you're kind of eliminating all the pessimists here, all those people here that don't like you. They're kind of being taken out of the company. So actually, it's a better, if you look at it as a takeover defense, it's a more efficient way to fight a takeover than a fixed price tender offer. At the same time, there could be very negative events, and these offers for legal reasons that obviously don't make too much sense, but they have to be open for 1 month. So during a month, a lot of terrible things can happen. So when a terrible thing happens, typically what will happen is this whole supply curve will shift to the right, and what will everybody do in a Dutch auction? They will simply all fill out $15, and essentially the company ends up paying $15 a share, rather than the $20 in the fixed price tender offer. So it's kind of you're hedged against terrible events. In some way, you're giving a put option, but the exercise price of the put option is actually going down in case of a crisis. And that's important for managers because managers typically in their press release say, we do not want to tender our shares, we have confidence in the future, but they may not be suspecting they were paying a premium of 30% above the market price. And this is why this is kind of a better hedge against unforeseen negative circumstances. Now, if you say, well, if you think about also another reason in a fixed price tender offer, the people that tender their shares and the people that hold on to their shares will get different prices. So it discriminates between different stockholders here, which is also the problem with the fixed price tender offer. In a Dutch auction, you expect the share price after the thing is over going to be roughly equal to the price that is paid in the Dutch auction, right? So if you think about, for many reasons, the many reasons here that in some way you can say that Dutch auctions are better than fixed price. You pay a lower price for the same number of shares. You get rid of the most pessimistic stockholders. You're hedged against the stock market crash, and the tendering and non-tendering shareholders get the same return. So this is kind of an argument here. The only main reason why people would still hang on to fixed prices because says a fixed price tender offer is really a credible signal. If I'm standing here and saying I'm willing to buy back 1 million shares at $20, I mean that's a more credible statement than saying I'm willing to buy shares between 15 and 20, where 15 is the current market price, right? So if your goal is to get your share price up, possibly, and it's for me the main motivation for that is that maybe someone wants to buy the company, and as we know in acquisitions you pay a 30% premium above the market price. You really want to correct mispricing by a fixed price tender offer. So that's the main argument I think here, why fixed price tender offer would still survive in this world where you have an alternative in the Dutch auction. The accelerated buyback is really the most controversial method. Actually, it's illegal everywhere except the land of the free, the home of the brave, United States of America. Because what you're doing here, essentially, you would like to buy back a lot of stock in a short period of time at today's price. But if I do that in the open market, I can do that because there are restrictions on trading volume, etc. If I do a tender offer, I have to pay a premium. So I don't like to do any of these things. So what do I like to do? I'm going to call my financial advisor, and therefore Goldman Sachs in 2004 invented the accelerated buyback. What's an accelerated buyback? Goldman Sachs is going to borrow shares and sells them to the company, let's say, at $10 per share. So they borrow 1 million shares, sell them to the company at $10 a share. So you're basically buying back 1 million shares at $10 per share today. Now, Goldman is short in your stock now, so Goldman has to cover. So in the contract, you make an agreement. I'm going to cover the shares for the next, let's say, 6 months. Now, if Goldman covers the short position and the stock goes on average from 10 to 11, then essentially they lose money, but they will charge you that extra $1 to the company. So the company actually is then buying back shares at $11, not $10 per share. If, on the other hand, your stock price goes down the next 6 months, then Goldman is making money in the short covering. And usually when I ask my students who gets the benefit, and everyone says Goldman, no, the benefit goes to the company, actually, that now gets a reduced price. So actually, this is a transaction in which a company is shorting its own shares, really, which is illegal, right, basically. But it's legal this way because it's done through an intermediary. So, and it's also controversial because when I think about the buyback, it sounds like I have confidence in the future. But this looks like an ideal transaction for someone that thinks, okay, my earnings are going to look very bad the next 3 months, so my stock price will fall. So I'm going to make money if I short the stock. But in the long run, I'm still a positive view. So this is kind of a weird buyback. That's why it's controversial. And but they like it compared to tender offer. There's no obvious premium. Obvious premium means ex ante, you really don't know. I mean, if your stock goes up the next 6 months, you will pay a premium, but it's not obvious from the beginning. And there is no restrictions on compared to open market on the price or the volume, because it's not you that is actually buying shares. It is the investment bank that is covering the short position. But it's a firm commitment, right? It's not, doesn't have flexibility. On the other hand, some people have justified it's a more credible signal than an open market because you really are confirming that you're going to buy back those shares. Now, there's some interesting papers on this published by Bergeron and Michel et al., and this is the second paper actually argues that these buybacks actually, in contrast to every other buyback out there, tends to be bad for long-term shareholders. Now, but that is based on a limited sample, so this is one suggestion for future research, is that you re-examine the accelerated buyback long-term performance, which has not really been done so far in the world here. If you think about the methods being used in buybacks, you can see here an overview of the number of announcements, and then the small little green box shows you the number of buybacks done to other ways than open market buybacks. You can see that open market buybacks are really the predominant way to repurchase stock, mainly 90%. If you focus on the ones that are not open market buyback programs, but then we have to limit ourselves to 94 because we have to use the Security Data Corporation repurchase tape, then you can see that most of the most biggest alternative method is private repurchases. If you look in the US, essentially at least. And one thing that you can also notice here is that the fixed price tender offer has been kind of going down relative to the Dutch auction, essentially here. And accelerated buybacks, the blue ones, actually have come out since 2005. If you look at the rest of the world, they don't have accelerated buybacks, and they seem to be actually having less Dutch auctions, and they're mostly fixed price and private repurchases here. What are the research questions that people have been worrying about is that why do companies buy back stock? What happens to stock prices? Why is there growth of buybacks around the world? Why do people choose different type of methods to buy back stock? And then the most interesting question, I think, is the market sufficient? Because all of the typical announcements, 90% of the announcements, the CFO will say, well, we believe our shares today are undervalued, and that's why we're buying back shares. But if the market is efficient, then this does not work, because then the price will go to fair value immediately. The company will not be able to buy back stock below fair value, so clearly it has to be here that the market must underreact, otherwise this statement that you see in the press release makes no sense. Is that really true or not? Are managers smarter than the market? That's a big empirical question. Now, why buy back stock instead of paying dividends here? What's the trade-off between the two? Now, what are the consequences for investment and employment? Because buybacks became very important, at least in the US. Politicians started being concerned about this and saying, well, this is actually bad for society, because what we're doing here, we actually are, instead of investing in projects, instead of employing people, we're giving money back to stockholders. So this is kind of an issue here about, are buybacks coming at the expense of positive NPV projects? And what are the consequences for liquidity here? Now, why do companies buy back stock? There's a whole bunch of papers written on this topic, and they're all explained in detail in the Bonnet and basically chapter here. And one motivation, of course, is moving the company to higher target net debt equity. Net debt basically means debt minus cash. So getting rid of excess cash, increasing leverage. Of course, this is the most obvious way to actually move to a higher capital structure. And this is kind of a proof, if you find proof of this, that indeed firms have target capital structures. Doing those tests requires for you to build a model of optimal capital structure, and then you see when the company deviates from this, if they trade below the target, the buyback allows them to move to the higher target. There is some support for this type of hypothesis. Signal undervaluation, saying that the share price, why do companies go up? Because they want to signal to the world, we have good prospects, our governance is good, we have lower risk than people think it is. And there's a whole bunch of signaling models, and I'm personally responsible for a few. In every signaling model, you need a theory that there must be a cost of false signaling, right? If you have a cost of false signaling, the signal is credible. In my paper, it's about for tender offers, if you pay a premium to buy back shares and the management does not tender its shares, then it must be that that signal is costly if you're not undervalued, because you will hurting the remaining shareholders. But you can also use Ross model, which is an old model, but it really deals with capital structure. Because Steve Ross' paper is saying that leverage is a signal. Why? Because if you have bad information, by increasing leverage, you increase the probability of bankruptcy, and that's going to be a cost. So only people that feel pretty good about the future can support this additional leverage. So that's kind of the signaling hypothesis. The second is take advantage of undervaluation, but it's really the opposite, because you don't want to signal. Actually, I don't want to reveal that I'm undervalued. I want to take advantage of all the dummies that think that my stock is worth $10 and benefit the long-term shareholder. This is actually where the distinction comes in. What should be the goal of the firm? It should be maximizing long-term shareholder value. And the people that actually do not believe in my company, we want to take advantage of them and benefit the others. And I'm going to show some evidence of that. That's indeed consistent with some of the empirical research. Reducing agency cost of free cash flow, as you know, Michael Jensen's paper is about, hostile bidders reduce agency cost by forcing companies to pay out excess cash. And of course, this is to be a forced event. In some way, you're forced by the managed, by outsiders or whatever, or activists to pay out excess cash, and that reduces agency cost. Fighting takeover bids, because by getting the price up, especially tender offers, you make it more costly for a bidder to buy your company, because typically a bidder has to pay a 30% takeover premium. And there's some evidence that's the case, that the likelihood of takeover bid is actually making it more probable that you actually have a buyback transaction. Reducing taxes on payout, because the typical argument is that dividends are taxed more than capital gains, and this allows you to pay less taxes. Provide liquidity. In other words, you have a company that's pretty illiquid, but a buyback at least creates a new buyer in the market, and that buyer actually may provide liquidity. This is actually in our paper on my first paper on private repurchases. That's an example of that. In the private buyback, you actually provide liquidity to large investors that want to exit the company. And then reduce dilution. A lot of companies are concerned with dilution of control, especially if in some way I'm giving shares to employees. Those employees will get a bigger stake in the company. I want to reduce that because the managers then have a slower stake. So buyback is done to make sure that managerial control is kept. And also some people call it's not just dilution of control, but maybe a dilution of earnings per share. As you know, there are two ways to increase earnings per share. Is to increase earnings, that's very difficult. The other way is to reduce the number of shares outstanding, and that deals more like related to manipulation, not really to creating shareholder value. Now, what happens to stock prices? Well, in my original dissertation, I had only two types of events: fixed price tender offers and open market buybacks. And this picture really hasn't really changed in general over the last 50 years. There's some things that never change. And what you typically see in open market buybacks, in the 60 days before the announcement, you see companies like underperform by 7% on average. And then the company announces a buyback and share prices increase by 3%. So 3% is the typical announcement that's been going on for the last 50 years. That hasn't really changed here. So people have not really get more enthusiastic about buyback announcement. In spite of all the evidence I'm going to show you that the market underreacts, people don't seem to care. So the market is up by 3%. In a fixed price tender offer, you have this humped shape here, you have this jump, and then this hump here. This hump is simply caused by the fact that the offer is open during a month, and during that month, the price is the weighted average of the tender price and the expected price after expiration. And typically the price after expiration is less than the tender price. In other words, the people that tender their shares on average get more money than the people that stay. And during this period, you will see this stock price hangs between those prices, and after the expiration, it goes back to the share price after the expiration, which is in this case, you get roughly a 15% increase in shareholder value if you do a buyback tender offer in this case. Now, this has not really changed, and I repeated this whole thing with my colleague Urs Peyer. We were looking at data now from 1990 to 2002, and there we can see here that that indeed you still get this hump shape in the fixed price tender offer business. And now we're adding the Dutch auction to it, and Dutch auctions share prices increase around 8% in the long run. It happens to be the same as in the fixed price tender offer. You also get in the long run 8%. Privately negotiated buybacks share prices go up on average. Accelerated buybacks, although it's a controversial thing, it looks like it should be you're shorting your stock, the share price goes up anyway, and the open market basically remains the same. So clearly, typically buybacks are good for shareholder value. It's one of the events that seems to be saying all the time. Now, you know, some research looks at what are the determinants, firm characteristics or buyback characteristics that explain announcement returns, and typically what are the typical variables. All of these variables you can tell a story about information, I think. You say in tender offers, the higher the premium, of course, the more convincing the signal is, and therefore you see a positive relationship. If the stock has gone down the last 6 months and you're announcing a buyback, then the share price essentially goes up more because people see, well, it must be driven by information. If your stock is small and you do a buyback, then your share price goes up more because people think, well, a small firm is less followed by analysts, there's more market inefficiency, they're also more held by insiders. If you buy back more shares, and that's true for any motivation, your share price goes up more. If you say in the press release, and this is interesting that when managers, of course you can always lie in press releases, but when they say the stock is undervalued, that is also a more credible signal around the announcement. If you're a market-to-book ratio, if you're a glamour stock and you're announcing a buyback, you get a negative response typically because they say, well, a glamour stock is a firm, it's a growth firm. It's actually a negative signal because you're saying my growth has finished and now I'm buying back stock in return. Insiders, when they own shares a lot in the company, well, it must be that they're really buying with their own money. It's a more credible signal here. And there's some other things that explain announcement returns that you cannot explain that much by signaling. But for example, probability of a takeover. If the takeover bid is probability is high and you do a buyback, people will say that it's a way to frustrate the takeover bid and actually going to lower the share price because it reduces the premium paid in takeovers goes to all the shareholders, not to a small fraction of shareholders here. When options are outstanding, means that many of these transactions are driven by dilution of ownership as a result of options that may be exercised, and that's not really driven by shareholder value here. Now, explain the growth of buybacks around the world, and there's some very interesting papers that you should read in JFE by Wang, Yin, and Zhu, which shows they actually have gone through time and looked at every country, many countries in the world, and looking at when did they start deregulating buybacks and what happens basically to share prices in those cases, etc. And it's basically deregulation. Employee stock option, because regulation does not happen like that. Regulation is still the result of lobbying by companies and others to change the regulation, right? And in the paper by Kale finds out that essentially the real motivation for adopting buybacks is the fact that suddenly the company is granting employee stock options and they're concerned about dilution of control if those options get exercised and the employees get a bigger stake. Also, managers get stock options, and they don't like dividends because, as we know, when a company pays a dividend, the stock price falls with the dividend per share on the ex-dividend day. So an option on a dividend-paying stock is worth less than an option on a non-dividend-paying stock. So this is an argument for reducing dividends and buying back stock instead, at least if the options are unprotected against dividend payments. In some countries, I'm sure many of you, the option is protected. In other words, the exercise price falls if a company pays a dividend, but in many countries like the US, it's not, and that's why that basically may explain why stock options plans actually create demand for buybacks. And there's an interesting paper by Julian Franks and other people about the changes in corporate governance. The Japanese are now the biggest repurchaser in the world outside the US, and they argue as a result of policy changes by the government saying you should change your governance and undo all your cross holdings. That basically means selling a lot of stock And in order to avoid selling pressure, the company is actually buying back shares instead. And that actually is one explanation why we see this, why Japan today has become the largest repurchaser in the world outside the US. Explain the choice of buyback methods. As we said here, this is the US buyback announcement by technique type. I show you this kind of a reduction in the use of fixed price tender offers. And why did fixed price tender offer become less popular? First of all, the accelerated buyback was invented, and it allows you to buy back large amount of stock without paying a premium. And there's also some serious mispricing of tender offers before expiration. It seems like the market is very inefficient. People do not understand what the price should be. And also the signaling power of fixed price tender offers has declined here. And what I mean with that is that if you look at my old paper, and somewhere here in the 70s, we see that the company's actually long-term share price goes up by 15%, but the company actually pays premiums of 23%. If you go in the updated graph, you can see the abnormal returns have actually gone down in the long run from 15 to 8%, but the premiums have remained the same here. Essentially, the repurchase premium in the 70s was 23%, and the return to non-tendering sale was 15%. Afterwards, the premium remains the same, but the abnormal return remains 8%. So clearly, it seems to be that is a less credible signal here. That's one argument here. That's one. It seems to be that there is less credibility in the signal, and there may also be less demand for signaling, because my argument for signaling is that it's a way to prevent or fight hostile takeover bids. And if you look at the percentage of hostile takeover bids in America, has gone down significantly, and that is a result of takeover defenses that were adopted. I mean, teaching finance in the 80s was far more interesting than today, I'm sorry to tell you. Because in the 80s was a world of hostile bids. Everybody was doing all the fancy transactions, leveraged buyouts, leveraged recapitalizations. And then all those managers got together and started inventing takeover defenses that made it almost impossible to do these things. And that has created a lower demand for signaling to undo undervaluation. Another reason could be, for example, that the agency costs have declined, that more managers care about shareholder value, and there's no more need to do hostile bids. But anyway, it seems to be that that's one explanation here. Another explanation is that one of the most biggest anomalies in the world, which for me, the biggest puzzle that makes no sense, is that the tender offer mispricing before expiration. If you think about the tender, what should be the price before expiration of an offer? The theoretical price should be the weighted average of the tender price, PT, and PE, the price after expiration, but the weight should be FP over FT. What I mean, the fraction purchased relative to the fraction tendered. For example, if a company announces a buyback for 1 million shares, and only 1 million people tender, then they will buy back all the shares from everybody, and FP over FT should be 1, and the price should be PT, right? So it should be the percentage of shares that you get from the tendered shares should drive the weight here. But if you look empirically, what we see is that the second model is used here. That the market does not seem to understand, that the market assumes that FT is equal to 1. They assume that everybody is tendering their shares, which is not true, because most people do not tender, right? I don't know why, because they get a premium of 23%. If they don't tender, they get 8%. I mean, any normal human being would tender, but people are not normal. I mean, unless if you doubt about that. So people actually seem to be completely irrational. They should be tendering, and they don't. And the market thinks they should tender, which makes sense. I mean, if I pay you a 23% premium and you expect 8%, you all should be tendering, but they don't. As a result, you get this incredible arbitrage opportunity that essentially the price after the announcement before expiration is massively undervalued. And in our paper, actually, we test a strategy. If you buy shares, let's say 3 days before the expiration, and tender them to the company, you get 9% alpha in a day. Now, this sounds great. Unfortunately, tender offers are disappearing, so it's not a reason for you to leave the PhD program and start your hedge fund, because there's no money in this, right? It's not enough. That's the problem here. It doesn't happen enough, and you cannot really build a business on this one here. But it seems like people mispricing the stock, and I guess that must be terrible for you as a CFO that you do this, and you see that many of your existing stock are selling their shares below fair value, And you're responsible for this, right? You actually did this. And therefore, that actually may explain why fixed price tender offers also have disappeared here. Are markets efficient? Big question. I'm from the University of Chicago, right? When I did my thesis is summarized here. I never looked what happens here afterwards. If I had looked afterwards and I find something like this, then Gene Fama would have said this cannot be because the market is efficient. Change the methodology so that that goes away, and then I would find this. But then if you find this, then Gene Fama would say, well, why did you waste my time like this? You know that the markets are efficient, right? So people actually did not do long-term event studies because it was difficult to publish these papers because you always have referees that say the markets are efficient and you can't make money. Because if you make money in the stock market, it means you're in the wrong profession. You should not be a PhD student. You should be running a fund and making money. That's what you should be doing. And this is, and as a researcher, you've taken a vow of poverty. You don't know that, right? You can never publish a paper that shows that you make money in the stock market. One paper I tried to publish was rejected from the Journal of Finance because the referee said, this is a vulgar topic. It's about making money in the stock market. You're not supposed to write these things. So, I mean, that's kind of a risky research. But the risk was reduced because then more and more people find anomalies. And my biggest luck in my life is to meet Joseph Lakonishok. Joseph Lakonishok was a non-believer. He was an outcast in the academic profession. You know, he was, I met him at UBC, was my first job as a professor, and he was a visiting professor there, and he was in the accounting department. That's the ultimate humiliation, that you're in the accounting department, because the finance area said, well, this guy does not believe in efficient markets. We don't want him around to pollute the ignorant minds of young people. By the way, Joseph Lakonishok today manages LSV Asset Management, which manages $120 billion, okay? Now that shows you, if you don't believe in efficient markets, you're going to make it. But if you believe in efficient market like me, you're going to be a loser forever. And that's the message here. But in this paper, we actually look at buybacks for the long run. This is done with David Eikenberry and me and Lakonishok. And we find that if you buy back stocks after the announcement, depending on which model of equilibrium you use. At that time, in 1995, the main variables were that size and book to market determine excess returns, not beta, and therefore you should adjust for book to market and size. And these are really, this is kind of the curve that does this is over here. This is where you have the book to market and size adjusted returns. And you can see that on average they beat the market by close to 9%. And remember, around the announcement, the stock went up by 3%. So really, in an efficient market, the price should have gone up by 12%, not 3%, suggesting undervaluation. Now, this is, of course, result has been re-examined by others and over different time periods. And can manage time the market. And then all the papers with me as co-author find yes. This is, of course, bias. And then some people, other people find no abnormal returns. Why could there be these differences? It has to do with different time periods, different methodology, but also different samples, because not every company is buying back stock because they are undervalued. You really have to look at which firms are more likely to be undervalued. And that's why it looks at what factors are correlated with long-term excess returns. And one variable is the market. You will recognize those variables. They're the same as the variables in the short-term announcement returns. In many cases, people actually underreact to these factors. That value stocks, if market to book is low, value stocks basically you get market to book is high, then the normal return is going to be lower. Prior return, I put it in bold here because that's the best predictor. If you really want to predict which stock is going to go up, you have to look at the prior return the previous 6 months as the most significant predictor variable. The market cap, if you're a small company, you get higher returns. And if the management says we're undervalued, you get higher long-term returns. And then you get a bunch of other variables here. that have different interpretation, but could be explained by asymmetric information here. Now, what we tried to do in my 2009 paper is to say, let's combine those first 4 factors here, which all look related to undervaluation, in an index we call the Undervaluation Index. What we do every time a company announces a buyback, we look at, we measure the book-to-market ratio, the market-to-book ratio, and if you're in the bottom quintile, means you are the most value stock of all the stocks that listed in the market on that day. We give you a score of 5. If you're in the top quintile, we give you a score of 1. If you're in the smallest market cap quintile, we give you a score of 5. If you're in the top quintile, we give you a score of 1. We read all the press releases, and if the management says we're undervalued, we give a score of 5. If you say nothing, we give a score of 3. If you say my goal is to maximize earnings per share, we give you a score of 1. If you are in the bottom past return, 6 months before the announcement, if you're in the bottom quintile, we give you a score of 5. In the top quintile, we give you a score of 1. So from this one, you can see that the maximum score is 20, and the minimum score is 4, and this is more or less the distribution that you get here. So the median and average is something close to 12. But as you can see, there are very few companies with a maximum score, very few with a minimum score. So now what we do, we test an investment strategy. We're going to invest in all the stocks with a score above 15, and we're going to invest in all the companies below 9, and if our mechanism is successful, we should do much better in the first group, in the second group. And this indeed shows up in the paper here. This shows the cumulative excess returns from 6 months before until 48 months afterwards. And as you can see here, the purple line shows you indeed the high undervaluation index companies. Per construction, they of course underperformed the market a lot by 35% in the 6 months before. Now, in the beginning, nothing much is happening here, which is essentially the market really does not really believe those managers, and they wait and see what's happening here. And I think there's some reason for this, is because typically we know from the asset pricing literature that there is something called momentum, right? Momentum is actually says that when a stock goes down like this here, you should sell. These stocks typically are downgraded by analysts, and all the analyst literature says you should sell when an analyst downgrades it. So the market doubts who should we believe, the analyst or the company? And in the long run, if you believe the company, get an alpha of close to 50%. This is Pharma French 3 factors adjusted excess returns. From the low U index firms, you get actually also get positive excess returns. Actually very difficult to build a sample where a company does worse than the market if they do buybacks. But obviously the message here is that you should, if you want to invest in, some of you may have some money left after you pay your tuition, then you should invest in beaten up small buyback companies that are value stocks, and this is essentially your return to heaven. You may leave the PhD program if you're becoming so rich. No, I'm just kidding. It's not so rich. We actually then also add those 2 other factors, right? The 2 other factors here is the volatility and idiosyncratic volatility, which we can also argue should in some way predict excess returns, because if a stock is more volatile, then there's more potential for mispricing. If there's a lot of idiosyncratic volatility, it's 1 minus R square, meaning a lot of company-specific volatility. There should be more company-specific information where indeed mispricing can be detected by the management here. If we use that index, we add that to the other factors, you get an extended undervaluation index. Then we need to get alphas close to 70% after 48 months. So clearly, it seems to be that the market is not as efficient. When I show this to Gene Farmer, then Gene will say, well, it doesn't matter. Why? Because you're talking about small firms, and small caps mean nothing economically. On the macroeconomic scale, this is irrelevant. And that's true. But on the other hand, investors may actually benefit from this personally. They should care about their own wealth, and therefore they may think this is actually something worthwhile talking about. Why buyback stock instead of paying dividends? And Again, here is what's the main difference between a dividend payment. A dividend is a long-term commitment. I always say dividends are like marriage, while buybacks are like dating. You know, there's no long-term commitment. If you pay a dividend now, you have to keep paying dividends forever. If you buy back stock, if you announce a buyback, doesn't mean you have to announce a buyback next year, and it's an option, so it's kind of very flexible here. Pardon me? There's no divorce, right? That's the issue here. The equivalent of divorce in finance is that you cut the dividend and your share price falls a lot, right? But here there's no reaction to not extending a buyback program. Buybacks are very low commitment, and open market repurchase is really no commitment whatsoever. Some companies try to turn it into a commitment by saying that we're going to have a repurchase plan, so-called 10b5-1 plan, typically done to avoid accusations of insider trading. You say, we want to take away the timing option on the buyback, and therefore we plan to buy back shares every month, a certain number of shares. But of course, high commitments means tender offers, private repurchases, accelerated buybacks. But as I show you, these events are relatively infrequent here. Now, if this is the aggregate amount of dividends in the S&P, in billions of dollars here, from 1998 to 2021. So as you can see here, the purple line shows you the dollar volume of buybacks, and the blue line shows you the dollar of dividends. As you can see, dividends grow gradually, very stable. Indeed, when there is a financial crash like 2008, you see some decline in dividends here, but not a lot. Well, you see a huge decline in buybacks. I mean, buybacks are only done when a company has excess cash and has debt capacity. In 2008, it disappeared for many firms, and then you see the buyback going down. The same thing happened here in 2020 during the COVID crisis. Suddenly, buybacks stopped because, you know, so most people say, well, this shows you that managers are stupid because they tend to buy shares at the high level of the stock market. But it's not that they're stupid, it's simply at the high level of the stock market, they have excess cash, they have that capacity, and that's why they can actually do this, right? Clearly, this shows you that dividends in some way have become a much less popular method to distribute cash than the rest of the world, which may be important for asset pricing people as well, that keep using the stream of dividend model in research. And you know, dividends really don't mean anything anymore. Very few people pay dividends here. And as you can see here, this is a graph that comes from the Boname and Cayley text here that looks at the percentage of firms that pay buyback stock, that's a repurchase only, dividends and repurchases, and dividends only, and then no payout. As you can see, firms that only pay dividends are now becoming a very small percentage of U.S. firms. In some way, you have now you only, like more than half the companies actually do essentially buy back some stock whatsoever here. Now, why would companies prefer buybacks to dividends? Well, firms, the nice thing about corporate finance, not asset pricing, you can actually talk to people, right? I mean, you can talk to the decision maker. You don't have to sit in your ivory tower and make up a theory. You can just ask them why you do things, right? And this is nice papers by Brav, whatever they ask. Simply, they ask CFOs. They say we like the flexibility of the buyback. It's not a firm commitment. And in the presidential address of John Graham, basically this year, he also interviews CFOs, and they say, well, our main reason is that we think our stock is cheap. Dividends do not affect my shareholders because there's no difference between tendering and non-tendering shareholders. So clearly, if I'm overvalued, I'd rather pay dividends. If I'm undervalued, I want to buy back stock. And this comes out in his survey. He says a survey of CFOs. What are the objectives driving payout decisions? And the blue lines show you for the dividend payments when it's and it's sort of important versus very important, and repurchasers are the kind of the yellow lines. And as you can see, the main difference between those in this table and this figure, the main difference between the two methods comes from the last line here, where they're talking about what is important. The most important thing for repurchasers is our stock tends to be undervalued. Our stock price undervaluation is the main concern for choosing buybacks over dividends here. Now, what are the consequences of investment and employment? And here, is there a dark side of buybacks, right? And here we have a bunch of papers saying that Managers manipulate earnings per share to increase their compensation because for a strange reason, executive compensation is based on EPS, which makes no sense, but if they do it, then you say, well, let's go and try to buybacks to increase EPS. Also, your analyst, everybody's obsessed with analyst forecasts. You just have to follow the markets, and when earnings are announced, and your earnings forecast are 5 cents a share, and you come in with 4 cents a share, your stock drops by 20%. So this is kind of an excessive obsession with analyst forecasts. So one way to do that is, and there's some papers that's by Almeida shows you that, and there's an interesting paper because they kind of calculate if you had not repurchased shares, you would have missed earnings per share forecast, and looks at those companies, and he finds that these companies that would have missed earnings per share when they buy back stock, they actually lower investments subsequently. That's been an argument for saying that they're actually sacrificing investment in return for meeting short-term goals, which may be related to the fact that they own shares and they want to sell those shares in the market after the earnings announcement, because analysts are restricted in terms of selling in certain windows, and it's kind of a good window to do it after the release of earnings. Now, this is an attempt to saying the short-termism is expensive for a good investment, right? Of course, if a company has no good investment, it should buy back stock. The purpose of a company is not to invest. The purpose of a company is to invest in positive NPV projects, and this is kind of oftenly missed in this discussion here. And now the biggest enemies of buybacks is the American Democratic Party, with her leader, Elizabeth Warren, keeps saying that stock buybacks as nothing but paper manipulation. Also, Joe Biden is going to kill buybacks, ladies and gentlemen. There may be no more buybacks after next year, because he's saying that the proposal will call for a 3-year freeze on corporate executives selling their shares after a buyback. Can you imagine that any executive will do a buyback if he cannot sell shares 3 years afterward? This will kill the whole thing. And what's this? So actually buybacks are after, fossil fuels are the biggest enemies of the Democrats, really. They basically cite research that company executives tend to sell far more stocks in days following a buyback announcement than at any other time. Now, the whole underinvestment story assumes that firms have no excess cash and no access to debt markets, which is very unlikely, because a typical buyback is about 1% of the market capitalization of the equity, so it's a trivial effect on your leverage ratio. The manipulation investment story assumes that, well, they're manipulating the stock price, it goes up, and then they sell their shares, and therefore means that the stock was overvalued, and then the stock will be undervalued later on, but all the research shows the opposite, right? Stocks go up, so there is no evidence whatsoever. In an interesting paper by Alice Bergeron and Jim Farrell, they look at a paper of dual-class shares, companies that have 2 types of shares, where the buyback is only on 1 class of shares, and essentially they showed no difference in the price behavior. So it's not that the buyback itself creates buying pressure, because, I guess, regulation prevents you from doing this. And the fact that insiders sell at the same time when companies repurchase is not surprising, as they're subject to the same blackout period. So this is not really a reason for concern. And also, what is interesting in the paper in the chapter by Berger and Kale show is companies with positive and negative earnings, what percentage of the firms are buying back stock. As you can see, the percentage of firms that have negative earnings that buy back stock is the same as the firms with positive earnings. So that basically means companies are losing money and they're buying back stock, means their loss per share goes up. Why would they do this if their obsession is with short-term earnings per share, right? It makes no sense whatsoever here. So anyway, this remains to be open for debate, and this is one of the controversial issues that you can address in your international sample. Finally, what are the consequences for liquidity? Some people have argued that liquidity is going to go down. Why? Because if this is all about asymmetric information, then the bid-ask spread will go up because you're trading against an insider. And essentially, and this is more or less the argument that is made by Barclay and Smith already in 1988, so the bid-ask spread should go up because I'm trading against someone that's informed. But this kind of ignores the fact that by putting a repurchase creates an additional buyer in the market that may provide liquidity. And some of the research basically given the fact that they're constrained by trades on inside information, essentially recent research actually no longer supports this and say that actually improves liquidity here. So what is this is about the past. What about the future? What can you do now to do some, because some people said, well, you have done everything about buybacks and there's nothing left. There's nothing left after me. Not really true. I mean, it's never over. No one ever sings the last song. So there is hope for you to expand on this. And the hopes come basically from the fact that buybacks are now becoming an international event. There's now far more buybacks around the world. You can assess robustness for all of these tests that are being done in the US, and then may get a chance to publish this in a good journal here. Exposing question, why do the markets underreact to buybacks? Do managers manipulate earnings per share? Do repurchases give up good investments? And of course, and not to forget, ESG. Who is here into ESG? Right. I was in a conference last week where half the papers were about ESG. So before you die, you should write a paper on ESG, right? This is the most successful consulting marketing concept in the world. I mean, this is unbelievable. And of course, people tell you, Theo, you should go with your time and do something about ESG and buybacks, right? And there's some decline in recent papers saying that long-term returns have gone down. Is this temporary or permanent here? That's the question. I did a little work on this on international long-term excess returns with Alberto Manconi and Speyer. And of course, this is a drawback of this paper is that it stops in 2010, so the data is about 12 years old. And it's also because if we had few data on individual countries, we have to pool everybody. We cannot look at buybacks in France or South Korea or whatever. We could do it in Japan because a lot of buybacks in Japan, but everything else, was not much going on at the time. But today the things have changed. At that time we had to pool the data. For example, one line here shows the top line here. The best repurchaser this is America ex-US. So this is Canada, South America, Mexico, whatever. These are pooled, these data. And these seem to be very good in timing the market, getting excess returns of close to 50% after 48 months. The next group is Asia Pacific ex-Japan. This pools a lot of Asian countries ex-Japan. We have Japan, of course, that, again, does not create a lot of alpha because I think a lot of them is driven by governance issues. And then the United States is still going strong. But the question is now we have, indeed, Europe. Europe in some way is kind of the least best performer. I think our argument is that in Europe, buybacks do not have to be approved by the board, but by the shareholders. So no one's going to call a shareholder meeting for a buyback, right? So typically what happens during a shareholders meeting, you will have, let's say, an resolution will say, well, for the next 18 months, we offer for buyback. So it's not really a signal that goes on in the country. So that may explain some of the low performance here. But what about ESG? ESG ratings measure concern about stakeholder value. This is not a big debate here. I hold these papers that I'm from the old school that thought the purpose of a company is to create a product and sell it to people at the price that's competitive, pay competitive salaries, pay taxes, and so everybody benefits. That was but now this is no longer the case. Now you're supposed to save the climate. So clearly, now the arguments here that ESG is concerned about stakeholder values and big societal questions here, while buybacks is really a vulgar obsession with shareholder value. It's really the ultimate capitalist act. It's against ESG. So someone said, ESG and buybacks are strange bedfellows. They should not be together. So is that the case that the likelihood of a buyback is lower when ESG is high, but then some companies with high ESG are still buying back shares, so why are they doing it in spite of being a high ESG firms here? And this is my recent incompleted research that is not available for whatever, but it's taped here, right? But anyway. So we have a little paper here that I'm doing this with Sterling Wang, essentially from SMU. And what we did here, we look at, for example, is we're looking at buybacks, equity issues, dividend increases, and M&A. And we test whether the likelihood of any of these events is influenced by ESG ratings. And indeed, we find that the higher the ESG, the lower the likelihood of a buyback, but ESG does not affect any of the other things. Which is kind of consistent with saying that the high ESG firms really are the firms that really do not care too much about shareholder value, and they're more concerned about the stakeholders, which do not really like buybacks. But of course, the ones that do it, what can we say about the ones that do it? We're looking at long-term excess returns over 48 months, and essentially here, we controlling for the low U index and high U index firms, and we're looking at low ESG versus high ESG companies. This is monthly excess returns using Fama French 5-factor models. As you can see from this table is that indeed the high ESG buyback firms are actually much higher returns than the low ESG firms, suggesting that, this is my theory, that ESG companies trade off alpha in heaven against alpha on earth, right? If you buy back stock, you will go to hell because you're a sinner. But on the other hand, sometimes you sin when sinning is very attractive. When sinning is very attractive, when you can make a lot of money. So they're trading off alpha in heaven against alpha on earth. Alpha on earth is making money against ruining their souls in the afterlife when they will no longer be able to go to heaven because they've sinned against the ESG doctrine. So that's our theory. This is very rough results, not to be cited by anybody. But this is going to be videotaped, right? This is in trouble here. Now, would the anomaly become less significant in the future? And there's some arguments here that maybe the markets have become more efficient in general, and hubris has increased. That a lot of, we used to go to school in my days, and everybody believed in efficient markets. Everyone believed that. Everyone was told in business school the markets are efficient, and please do not try, tell the CFO, do not try to buy undervalued stock. It's a waste of time. But people have kind of lowered their beliefs in this, and there's overconfidence here. And maybe it's been the case because people have responded to my research. People have taken me seriously, right? And therefore they've been starting funds trying to exploit my data. Right? That would be one reason why it's no longer there today, right? It could be happening here. Who knows? Well, our hubris, now this interesting, again, survey was done by Graham in his presidential address, where he basically he asked the question is, to all the CFOs, is your stock undervalued or overvalued or correctly valued? And what is now essentially showing here is that the firms, the people that actually are feeling that their shares are undervalued, he did a service in the 90s, in 2000, 2002, 2011, 2020, and the basic trend here is that today more people than in the past believe their stock is undervalued. In other words, there's been a biggest distrust of stock markets than ever before, and that may create that a lot of people are maybe get too much into buybacks and thinking that there is an arbitrage opportunity, but that's not the case here. Maybe they're infected by hubris. Maybe portfolio managers make the markets more efficient. Now, for me, it's unlikely because the announcement returns are the same like 40 years ago. It's not that people get more excited by the buyback when they did 40 years ago. I mean, it's still around 3%. Now, it's unlikely if the markets were efficient, what would happen is the CFOs would not complete the buybacks, right? They announce a buyback program, the price goes to the fair value, and they would not do them. In other words, everyone would do a buyback announcement and nobody would complete them. But if you look at studies on completion, 90% of buyback authorizations are being completed. So everybody the CFO still believe that the market underreacts. And why does it get little attention? Those of you, how many of you are in asset pricing here, empirical asset pricing? Okay, a few people. Well, this gets very little attention in the asset pricing literature because everybody talks about the net issue anomaly. They do not even respect the buyback anomaly. They call it a net issue anomaly. Net issue basically means issuing minus repurchases. But they look at the number of shares outstanding over time and see whether that's related to future returns. But first of all, that's kind of a misleading statistic because many companies buy back stock and issue at the same time when they essentially are the company, people exercise their options. They essentially buy back those shares after the options are exercised, so the number of shares doesn't really change, although the company did a buyback. And also issuing shares is a different story, taking advantage of overvaluation it's a different story than taking advantage of undervaluation, because in a buyback, you take advantage of the people that leave the company. You don't care about them. If you start issuing overvalued stock to people, you actually are hurting the people that just become your shareholders. And this is not a very good investor relations mechanism here. And this is something that you don't want to do. So you should look at these two events quite independently. And there are very few specialized buyback funds here. And the reason for that is because it's a small cap anomaly. How do asset managers make money? They make money by fees. And bigger the fund, the bigger the fees. But you cannot have a big fund with small caps, right? So this is why there's very little, I would say, funds that try to exploit this. And of course, I tried to do this. And once in a while, I'm trying to make money, to get out of poverty that is associated with academic jobs. And this is why I launched the first buyback fund in the history of the world. KBC Buyback America, announced in July 1998 with a Belgian bank. And I told, and this is very interesting because there were no buybacks in Belgium, right? So you have to tell the Belgians to buy something they don't know anything about. So the way we sold the fund was saying, this is legal insider trading. And the Belgians, they love it, because if you do something that's kind of illegal, half of it, they really think that's a great thing. That's why we have a lot of people like to speed in Belgium. We like to do things that are not allowed by the government. And they say, this is great. That's how we market the whole thing. And I told my Belgian investors, do not call me. I was a professor in INSEAD. I had an office there. I didn't meet any of them, right? And I told them, just relax, don't call me, I will call you, right? So we started in July 1998. And typically, whenever I start a fund, there was a major stock market crash. After July 1998 was the Russian debt crisis. So what happens on December 98, my fund was ranked number 74 out of 75 North American funds sold in Belgium. This was a very humiliating time for me. Whenever I went back to Belgium, I was wearing my dark sunglasses. They saying, my mother denied that I was her son, because many people in my village had invested in the fund and they were losing a lot of money. But then a miracle happens, huh? Miracles happen everywhere. And on basically March 9, 2000, I was ranked number 1 out of 75. What is March 9, 2000 is the absolute top of the stock market at that time. It's absolute top of the NASDAQ. On that day, my picture appears in the Belgian Financial Times, the Financiële Economische Tijd, of a big interview. And people ask Prof Vermaelen, what do you think about the future? And I said, the future looks bright. Immediately after that, the market crashes. And then eventually I got fired in February 2004. I got fired in spite of the fact that in February 2004, this is the ranking of all the funds sold in Belgium and the Netherlands. And you can see KBC Buyback America is ranked number 1, looking back, 1-year return, 3-year return, 5-year returns. So then the question of you all have, why do I get fired if I'm so good? You expect I've engaged in some type of criminal activity here. But the obvious, simple explanation is that the bank actually paid me. I didn't get a salary. I had my salary from INSEAD. I was paid a certain percentage, 5% of the alpha of the fund. But the alpha of the fund in 1 year was 70%. I was paid 3.5% of assets under management. And the problem is the bank had never charged those fees to the customers. This was an internal consulting contract. So the bank was losing money. And the customers were happy, I was happy. And this is what we call a non-compatible incentive contract. And this is why I was asked to leave here. Now what I do afterwards, this is another story, another talk. I have another fund here, but I don't want to talk about it because then you say I'm abusing my invitation to sell a fund, and I don't want to do that. But indeed, there is hope. The problem is there's been very little competition here because it's indeed it's small cap, and I have a job at INSEAD, so I can afford to do this. But other people basically, if you want to do an independent buyback fund, you know, if you focus on small caps, there's not enough money in it, and this is why there's no competition here. But of course means that this anomaly will persist, and it's good for small people like you, for the individual investors, to take advantage of this, because this is not being competed away for, I would say, institutional reasons, and that's why it still exists. And also means for corporate finance that managers should not always believe that the market is efficient, and they should take advantage of undervaluation. You should not trust efficient markets all the time. That's the case, and therefore there is an opportunity to time the market, and this is actually something that you should be involved with. So this is more or less, I'm finishing here on time. Thank you for your attention. Are there any questions maybe, because who knows? Any questions that you may have? I have what? I have 5 minutes? No, I'm finished. 9:45. I'm exactly at the time here. I'm just amazed how time is. Well, anyway, then thank you very much. Thank you.
So, any question?
No, I guess nobody cares about buybacks. That's why
John.
Thank you very much. Thank you.
Encouraging us to deliver market efficiency.
Because I'm retiring next year, okay? So I'm going to stop doing research. So someone has to take over from me in this area.
John, we have questions.
Oh, I'm sorry.
Oh, okay, good. Yeah, there are actual there's some actual people look at because in the US now companies have to disclose since I think it's 2004 the actual repurchases they made and the price they paid for the stock. So if you look at actual repurchases, you also get the same effect. They get long-term excess returns. The problem with actual repurchases, they may happen much later than the announcement, right? If I'm announcing a buyback authorization today, the actual repurchase may happen 2 years from now. So you're missing the alpha after the announcement, essentially, and this is why looking at actual repurchases it may not be the best strategy for you to detect abnormal returns. Any other questions? No one?
The session is over.
Session is over, so have a good day. I get a degree in finance. Thank you very much. Thank you. Thank you.
Okay, we'll take a very short break, right? And then we'll proceed with the rest of the PhD seminar in our groups. If you belong to asset pricing, you go to the asset pricing room, or if you belong to the corporate governance, you go to the corporate governance, and both rooms are on this floor on your way out, left and right. All right? Now we're going to talk to the stuff. Thank you.